Good evening, everyone. I hope you're doing well. It's not my place to comment on the political aspects of what's going on with the conflict between Israel and Iran, but I just wanted to show how the charts are developing and the impact it's had on some of the investment markets, especially oil, and some of the other trends we've looked at in previous videos, like looking at the stock markets topping out, looking at the debt markets potentially bottoming out, and we've seen some of that play out on the charts. And this latest conflict may be a little bit of a catalyst to sort of solidify those trends. So let's just get this title card out of the way so we can see the charts. And firstly, I've got the US 10-year bond yield up there, but let's firstly have a look at what's happened in the stock markets. In fact, we might start with the price of oil because that was the big news on Friday. And many of you who've been following my videos or following some of the trends I've been showing these charts, whether you're a client or not, you can see that the oil chart now has clearly broken out. So this is a daily chart we're looking at here. And I've shown this in a couple of previous videos and I've spoken to clients about it. We can see straight out of the textbook, you've got a falling, the peak in oil, at least in the short term, in January, peaked at around $80 a barrel, and it's been in a downtrend since probably May. Falling broadening wedge, which is bullish. You've got the double bottom there at $56. You've got positive divergence on the momentum indicators. You've even got a inverse head and shoulders pattern forming there, which is generally a very bullish buy pattern. So lots of reasons to be bullish on the price. Then, of course, you've got the break of the neckline there, the break of the head and shoulders neckline, the break of the downtrend, a little bit of testing of the previous highs there, the neckline, and then big pop. And in fact, on Friday, at one point, the price of oil was up over 13% on the day. It finished up about 7%, 7.26%, according to TradingView. So it did cool off a little bit, but a clear breakout now, and obviously driven by some of the fundamentals, some of the news with what's going on with Israel and Iran and all the things in between and all the things that relate to that. But you can clearly see it's in a breakout now. I mean, it's very likely that it's going to come back down for another test, possibly, although we'll have to wait and see what happens over the next couple of days, whether this conflict escalates. I mean, Iran has already retaliated. The oil market is obviously closed at the moment, so we don't know where it's going to trade yet on Monday. A lot can happen between now and Monday, but something to keep an eye on. But I think even just from a charting or trading perspective, I think it's broken out. And, I would expect that at some point later this year, we nearly got there on Friday, but there's probably going to be a test of that $80 high coming again. And then, of course, if we zoom back to a 5-year chart, you can see the congestion of what I've been drawing down there. But oil's essentially been in a downtrend for over 3 years now. You had the double top back in 2022, with the same signals we look at all the times, negative divergence on the momentum indicators, and then, of course, oil in a downtrend. Let's just clear all those. And if we were to draw the downtrend from the 2022 high, have a look at that. You can see it was in the downtrend, and then it broke the downtrend, and then it's been testing the breakout, tested it again. Look at all that again, straight out of the textbook. We see this all the time, and now the big green candle. So I would suggest that probability favors that oil has completed its 3-year downtrend. We've had lots of tests of it was still in a downtrend here, obviously, uh, just because a downtrend breaks, it broke there about a year ago, about March 2024, so a little over a year ago. But just because a downtrend breaks doesn't mean an uptrend has begun. So the downtrend needed to continue to test the breakout, and we've had the test now. And I think at this point we can say with a reasonable degree of probability that the price of oil has bottomed, and that may be the last time we see the price down in the $50 range. Let's come across the stock markets now. We've talked in previous videos about the speed of this recovery in stocks and just some of the topping patterns forming, and you can see it developing further. Again, this is on a daily chart. You can see this rising wedge pattern. You could draw it there, you might even draw it there, but again, we've got rising wedge, we've got negative divergence forming on the momentum indicators. You can see this fast recovery. Now we're starting to roll over, and if we zoom in, because we're looking at a futures contract here, essentially, or the S&P 500 E-mini futures. So this is a contract that continues to trade after hours. through obviously not through the weekend, but through business days. And I've talked in previous videos why I'm preferring this at the moment over the regular. The charts are very similar, but I'm just preferring this over the regular market index chart. If we zoom into, we're on an 8-hour chart now, you can see so the US market bottomed on the 7th of April, and you can see very speedy recovery, uptrend, uptrend. But have a look at that. I would say that was the first sort of rising wedge that broke. In fact, when you zoom in on an 8-hour chart, it looks like the rising wedge has already broken. And you've got, as you're making highs there, you're making slightly higher highs there, maybe another little rising wedge. And if that's the case, you've got a little breakdown happening there. And what are we seeing? The same patterns, negative divergence on the momentum indicators. As per always, I'm either too early to these things, but I was getting very bearish in previous videos. If you go back and look at my videos from, 2, 3, 4 weeks ago, I was sort of getting very bearish here, and you can see we've just been going sideways with negative divergence. Again, I would say it's most likely that markets are topping. Keep in mind, this is an all-time record high as well. For my clients and I, again, I can't give investment advice in these videos, but for my clients and I, when markets are within, what is that, even after the sell-off, within 2 to 3% of an all-time record high after a super speedy recovery, that's not a time for us to be chasing growth. We're in safer funds, high income funds, that sort of thing, and we have higher allocations of bonds. We have our gold, and we have some other commodities, that sort of thing. So it's going to be the same thing with the Nasdaq. Nasdaq and S&P are very similar these days because of the mega tech companies just dominating the index. If we look at the US dollar, this is another thing I've been talking about in previous videos. The US dollar has, we saw a longer term version of this on the oil chart. But if we have a look at the US dollar, you can see since January, it's been in a downtrend. What's happened? Broken the downtrend, and now it's testing the downtrend. You can see it bouncing along. So the previous roof or resistance now becomes the new floor, the new support level. It did make a marginally lower low on Thursday, that was, but you can see there's positive. I've left it a bit of space to breathe there, but you can see positive divergence. So as the price making a marginally lower low, momentum indicators diverging, making higher lows, that's generally a buy signal. US dollar has had a significant sell-off. I would say most likely the US dollar is continuing to form a bottoming pattern here. Just be wary of US dollar strength. There's a lot of gurus out there calling for debt collapse, US dollar collapse, and I philosophically understand and agree with a lot of that position, but let's just keep in mind the markets can do their own thing, and we should be a little bit more agnostic in our investment approach. And that doesn't mean putting all your portfolio in the US dollar. It just means possibly having some, just being aware that if the US dollar strengthens, it's probably going to put downward pressure on stock prices, on a lot of commodity prices, global real estate funds. Just be aware that US dollar, for my clients and I'm just being a little bit cautious. We're wary of US dollar strength. Now, something that has been strong is the price of gold. Now, I was, I reduced clients' positions to precious metals to roughly 10%, although some clients are still at around 12 or 13% just because the prices keep going up. Silver's had a good run, for example. But gold was, it topped out. We hit an all-time record high on the 22nd of April. Now, it's not currently at an all-time record high. It's about $50 away. But what it did do was close at a record closing high. So 34.52 on the futures market. That is a record close for gold. It did trade as high on the 22nd of April. It traded as high as $3,509 in the futures market. So we're still about $57 off the high, but that wasn't a closing price. It actually finished that day. On that day when it hit there, it closed at $33.92. So it had a significant sell-off, over $100 within the same day after hitting that all-time record high. But you can see again this classic breakout pattern. You've got the flagpole. And it's a little bit messy, but you can see the trend. You've got the flagpole, you've got this flagging channel, touch, and then the breakout. And if we zoom in on a 8-hour chart, you can see this a bit better. It's a little bit more clear. You can see a very clear trend. You've got this flagging channel, which is generally resolves to the upside. And then what happens? So you've got the resistance there, the third touch, then it comes for a fourth touch, breaks out, find some short-term support at the previous high, test the break, the resistance line, the breakout level, and then what does it do? Rally to a new high, breaks out above that level. So it's looking a lot more positive for gold. Again, I'm not um, I'm not aggressively buying gold. I'm not increasing positions to gold. We're just my clients and I, we're continuing to maintain our 10% allocation. We are very concerned about a lot of the things that are going on in the world. And for me, gold is insurance. I am bullish on precious metals in general. I just think things like silver, platinum, and palladium far more risky. Prefer to have as some call the God market, which is gold, and silver has had a good run. If we go to a daily chart on silver, you can see I actually got this one wrong. I thought silver was going to, well, I did call it there that it was a sell, and came back down to the previous low, did spike below, but you can see you bought the previous low, and then big recovery, 25% recovery. It's now broken out. So it probably needs to come back and just test this line a little bit. Maybe we'll get a pull back to the sort of the 34 level to test these previous highs here. But longer term, it's looking much more positive for silver. It is looking like a breakout, and I'm sure if you're following some of the gurus online, there's a lot of people talking about silver and the longer term implications of this breakout. I mean, if we go to an all-time chart, you're probably seeing a lot of your favorite gurus talk about this sort of cup and handle pattern. You got the cup, and well, I guess that was the handle. It's a little messy. I have seen better charts. It's probably better to look at it in a logarithmic chart. But silver is certainly, let me just clear that again. We're on a monthly chart here. That goes back to the 2011 high where it hit $50. I mean, you can see this is even just on that monthly chart, you can see the resistance level around $30, a key psychological price level. And we've now broken out. We've done quite a bit of testing of the $29, $30 level and on to a closing high. We'd have to go back to 2012 to find, maybe even further than that. You might have to go back to 2011 to find silver closing at a higher price than what it closed at this week. So that is a 14-year closing high for silver. It's had a good run, so I'm cautious in the short term, but longer term, long-term time horizon, looking positive for silver. It looks like it may have finally broken this sort of 5-year, or well, really you could say it's been in a downtrend since from 2011 to, say 2024, probably a 13-year downtrend, and that break at that $29, $30 level is, I think that's a longer term breakout, looking a little bit more positive for silver. Bitcoin, I've talked about Bitcoin quite a bit on other videos. I think it's had its uptrend, bottomed on April 7th, very correlated. It's a risk asset correlated with stocks, with global liquidity. It's a risk on asset. So when people are looking to when the markets are feeling good and they want to take some risk, they're buying stocks, they're buying Bitcoin, and then it's had a good run. You can see pretty clearly it was in an uptrend channel. It's broken down from the what's that? 28th of May, broken down from the uptrend channel. Hasn't quite returned to test the previous high. I mean, that might be it. I don't know if it's going to come back for one more test. Maybe it needs to test that level again, but I would be exercising caution. For me, this is too risky of an asset to be owning when it's very close to an all-time record high price, and it's just had a run from 8th of April to the 22nd of May, 51% run. I mean, for me, that's something that if I had significant positions, I would take profit, shift to relatively undervalued assets. But the chart's not looking good at the moment for Bitcoin. So I would say in the short to medium term, I think, if we look at what's happening with stocks, we look at the US dollar potentially bottoming, Bitcoin breaking down from an uptrend. It's probably not looking good for Bitcoin over the short to medium term. Long term, I have no idea. I'll wait for the charts to tell me a story, and we'll see where it's going from there. Now, if we just briefly look at the Australian market, we're going to see the same sort of thing. And you don't have to be a charting wizard to see that this was the bottom on April 7th, massive run up in Aussie stocks from the low there to the high a couple of days ago, 20% recovery in the space of 8 to 9 weeks. That's a very sharp recovery, but you can just see the recovery starting to run out of momentum. And of course, that is the all-time record high for the Aussie market, and we just hit that this week. And we're hitting it with negative divergence on the momentum indicators. That's generally a sell signal or a sign the uptrend is losing momentum at the very least. And the other thing too is I don't know how you would draw a rising wedge there. I mean, maybe if we go to a shorter term chart, we can see the bottom uptrend, first uptrend sort of broken, uptrend continues. A little bit hard to read there. It's a very narrow channel, but again, we're seeing negative divergence even on the 8-hour chart. We're at the all-time record high for the Aussie market. If we go to, a weekly chart, potential double to maybe it'll make a marginally higher high. It might trade up here a bit, but you can see negative divergence again on the momentum indicators. It's just the time to be very cautious in stocks. I'm not saying stocks are going to crash. I'm saying stocks have had a good run. They're looking expensive again. Aussie market at all-time record high. I don't think you want to have a super aggressive allocation to Aussie stocks when the market's hitting an all-time record high. You want to buy low and sell high. And this is a sell high scenario. Yes, can go higher. And for my strategy, we're not completely out of Australian stocks. We're just in high income funds, safer funds. We're not chasing growth. And we do have 3 to 5% of our portfolios in short positions. So on the US market and the Australian market, again, not because I'm trying to speculate on a crash, just because I'm hedging portfolios. We have long-term, high income paying portfolios, and we need some protection and some hedging strategies. And we'll just have a really brief look at the debt markets. We'll just look at the key interest rates of the 10-year yield on the US 10-year bond, and we'll look at the 10-year Australian yield. We'll go to a daily chart. I've shown this in previous videos. My video last week was about, are we in a debt collapse? You've got all these gurus telling you it's a debt collapse. It's a debt collapse. Well, why is the interest rate, or effectively the price of US government debt, the same as it was 3 years ago if we're in a debt collapse? And, I'll just briefly show this again. I think I talked about it in the last video, but if it's a debt collapse, and you can see I've drawn stuff there, if it's a debt collapse, how come the Greek government can borrow money for 10 years at 3.3% interest? Or the French government at 3.25%, Italy 3.5%. Germany can borrow at 2.5% for 10 years. Remember, that's before adjusting for inflation, before adjusting for your income tax or the tax you pay on the income return you get from those bonds. I continue to maintain that I think that it doesn't mean that I think debt is a great investment. I just think central banks will prop the debt up. They've been, we've seen the European Central Bank cut interest rates 10 times now. It's not having as much of an effect on long-term rates as they'd like, but keep in mind they can at any time launch their quote money printing programs. They usually call them asset purchase programs, QE, quantitative easing. Sometimes they call it yield curve control. It's all just different flavors. It's the same thing. They print money, they invent money in their computer, they buy up government debt to artificially suppress interest rates so that these bankrupt governments can continue to spend way more than they can collect in taxes. And we are probably already in a global recession, depending on how you want to measure it and whose numbers you believe or don't believe. So, this theory that I'm not saying the debt can't collapse, but to think that central banks have a look at what they did in 2008, look at what they did in 2020, to sit back and think that they're just going to allow these governments to default on their debt and not be able to make, payments to retired people, age pension payments or social security payments, or pay for Medicare systems, which eat up a significant portion of most Western government budgets. If the debt collapses, that means, doctors and nurses don't get paid, Medicare doesn't work, age pensions don't work. If you think that's going to happen, I'm not saying you're wrong. I'm just saying that that's very unlikely, especially in the short to medium term. Central banks they can create unlimited dollars and they can buy up all the debt if they want. Obviously, that's a terrible thing. But we'll come back to the charts real quick and we'll see on the 1-year chart for the 10-year US government, or the yield on a 10-year US government bond, you can see there's a bit of a breakdown, and depending on where you want to draw the rising wedge, you could draw it there, you could draw it there. There's a few places to draw it, but you can see it's in a bit of a breakdown, had a little bit of a spike up on Friday, but I mean, that chart is looking reasonably bearish. It's looking like, we had a big rise in the interest rates from 2024 to the start of 2025. and now we're just sort of breaking down in the short term again. If we look at Australia, it's looking even more bearish on the Aussie one. Let's just clean that up a bit. You can see we're well off the highs, and since late 2024, it's been in a downtrend. We could draw the trend across there. You could argue that this is a pretty key support level, this 4.1% level, and maybe in the short term, there's going to be a little bit of a bounce in long-term interest rates in Australia, which means bond prices would come off a bit. But they've had a good run of late. Remember, if the yield or interest rate is falling, that means the bond price is going up. Not a whole lot to say about this chart, but I'm expecting at some point we're going to see a breakdown. The market is pricing in a strong probability of a Reserve Bank of Australia interest rate cut next month in July. I think the probability is currently about 85%. They'll probably cut 2 or 3 times this year. Again, I've talked about how we're now currently in the, quote, back-padding phase of the inflation fight, where politicians and central bankers and bureaucrats are patting themselves on the back, saying, job well done, we've solved the inflation problem that they created. And I think we're in the process right now, this sort of 18 to 24-month period of them kicking off the next major wave of inflation. And just because we have inflation doesn't mean, or if we have inflation in 2026, 2027, if we see it spiking back up again, and of course oil prices spiking, and this Iran-Israel conflict can actually speed up that inflation process. Oil is a key driver of inflation. That doesn't mean that these interest rates are going to go up. Keep in mind, we could be experiencing the inflation as a consequence of central banks like the Reserve Bank of Australia, like the European Central Bank, the Federal Reserve. The consequence of them suppressing interest rates on government debt will be the inflation, which they will, of course, they will try to deflect blame. It'll be greedy corporations. It'll be Putin. It'll be the conflict. And yes, the Israel-Iran conflict will be, well, let's hope it's not, but if it continues, it will be a factor, but it's not the main reason for inflation. So we're at a little bit of potentially at a turning point in major markets. It looks like stocks are topping. It looks like risk assets like Bitcoin are topping. It looks like the so-called safe haven assets like bonds, debt are bottoming and getting ready to push up from these historically low levels, depending on which market you're looking at. Certainly US debt markets, if you look at TLT, just briefly look at that, the long-term US government bond fund, that's a 5-year chart. You can see the little rally barely registers on the 5-year chart, and it remains down about 50% from the 2020 highs. So it is relatively a very underpriced, or I don't want to say undervalued, we'll say underpriced asset class. So hopefully that's an interesting summary of the charts. We're at some key turning points, and I think the next week or two, we're going to see if I'm correct about these turning points, or maybe the charts will defy probability, and if that's the case, we'll reassess at that point. But thank you for taking the time to listen, and I'll be back with another video soon. Cheers.